Welcome to The Explainer. Look, if you're sick and tired of watching your hard-earned cash just sitting in a slow savings account, barely even keeping up with inflation, well, you are in exactly the right place. Today, we're taking a highly structured journey. We'll start with a really quick optimization of our market fundamentals, and we're going to take that all the way to mastering a portfolio that can literally change your financial future. Okay, let's dive right into this. $60,000. We aren't just kicking around abstract financial theories today, guys. We are detailing exactly how you can build a portfolio capable of generating nearly $60,000 in annual, completely passive dividend income. That breaks down to roughly $5,000 every single month, just for owning the right assets. But of course, the massive question staring us right in the face is, how on earth do you build that with just $10 a day? I know, Wall Street can feel like this intimidating jungle, even for seasoned investors. But as you'll see, you absolutely do not need a hedge fund budget to pull this off. By the end of this explainer, you're going to see exactly how consistent, small, daily micro-habits are actually the ultimate tool to leverage the market's mechanics and build some seriously life-changing wealth. So here's our blueprint for today. Number 1, the $3 million goal. Number 2, decoding stock market basics. Number 3, choosing your investment strategy. Number 4, the magic of compounding. And finally, number 5, building the target portfolio. All right, let's kick things off. Section 1, decoding stock market basics. Now, we all know that buying a stock means you're owning a slice of a real-world business, right? But for this specific strategy, we're laser-focused on dividend stocks. We're not out here looking for speculative digital lottery tickets. We want established companies that pay a regular, hard cash bonus, usually every quarter, just for holding our slice of the pie. That regular cash flow, that is the absolute crucial fuel for our $3 million engine. And when you're actually executing your strategy, you've basically got two main choices. A market order is going to get you in immediately, but a limit order, that is a dividend investor's best friend. Because by specifying the exact price you're willing to pay, you effectively lock in your target dividend yield. So it's really a trade-off between the fast, immediate execution of a market order and the precise mathematical control of a limit order. So, the crucial point here is when you're placing that order, keeping an eye on the bid and the ask and the spread between them is totally vital. Massive blue-chip companies usually have a microscopic spread. But if you're hunting for higher yields and smaller, maybe less liquid dividend stocks, a wider spread can really eat into your returns over a 30-year horizon through something called slippage. It's kind of like a hidden cost, so you've absolutely got to monitor it. Moving right along. Section 2, choosing your investment strategy. Let's break down 3 main approaches. First up, value investing. This is basically the Warren Buffett playbook. You're hunting for fundamentally strong, dividend-paying companies that are just temporarily undervalued. It's high effort, though. Now, if you want low effort, go passive. You buy a broad market ETF, you get instant diversification and zero stress. And finally, growth investing targets rapid expanders. Think Visa. The dividend might be tiny right now, but the capital appreciation can be massive. The real trick is blending these together to perfectly match your own risk tolerance. Now, if you do decide to pick individual stocks, you've got to look under the hood to cure that classic analysis paralysis. Think of these 4 metrics as your diagnostic dashboard. The PE ratio, that tells you if you're overpaying. Price to book compares the stock's price to its hard, tangible assets. Earnings per share is basically your profit per single share. And the dividend yield is your exact passive return rate. Used together, these 4 act like a total force field against blindly buying overvalued assets. Okay, Section 3, the magic of compounding. This right here, this is the absolute secret weapon, the Dividend Reinvestment Plan, or DRIP. Instead of taking your quarterly payouts and spending them, you set your account to automatically use that cash to buy even more shares of the same stock. I know, it sounds super simple, but it creates this relentless snowball effect. Your money buys shares, those shares pay dividends, and those dividends buy more shares. Honestly, it's the closest thing in finance to a perpetual motion machine. And this brilliantly illustrates exactly what that snowball effect looks like in reality. Let's take Hawthorne Bank as an example. If you invested $10,000 and consistently reinvested the dividends, well, in year 1, your portfolio crawls up to just over $1,300 in growth. It feels kind of slow, right? But look at the hockey stick growth. By year 10, you're at $37,000. And by year 30, through the sheer brute force of drip and market appreciation, it skyrockets to over $1.8 million, potentially paying out $100,000 a year in dividends alone. Crazy, right? Which brings us to the top of the pyramid. Section 4, building the target portfolio. So what does this well-diversified wealth-building machine actually look like? Well, it's a precise 5-asset blend. We've got Coca-Cola anchoring us with that rock-solid blue-chip stability. Then, the S&P 500 Dividend Aristocrats ETF gives us broad exposure to companies that are historically famous for raising their payouts. We add American Tower for a nice high initial yield. And then we balance the whole thing out with NetEase and Home Depot for massive capital appreciation potential. It really is a masterclass in balancing cross-sector risk. Let's move to and see how this builds over a 30-year timeline. If we apply all our metrics and strategies, starting with an initial $10,000 investment and then adding just $2,000 annually, which perfectly mirrors that super manageable $10 a day contribution we talked about earlier, the math is just staggering. In year 1, with your steady contributions, you're sitting at $3,600. By year 10, you've crossed $84,000. By year 20, you've got over $500,000. And by year 30, the compounding effect absolutely explodes your wealth to $2.84 million. Let's just pause for a second and take in that final massive number, $2,843,896. And you know what's truly remarkable here? It isn't just the size of that final number, it's how you actually got there. Out of that total value, over $2.3 million comes strictly from capital appreciation and the compounding of those reinvested dividends. Only a tiny fraction of that entire sum actually came out of your pocket as daily contributions. Guys, that is the literal definition of making your money work for you, rather than you working for your money. So the roadmap to nearly $3 million and $60,000 in passive annual income is right here in front of you. Perfect knowledge doesn't exist, we all know that, but the pure math of compounding absolutely does not lie. The most expensive thing you can possibly do right now is just sit back and wait. So the only question left for you is, are you going to let another day of compounding slip by, or will you set up your first $10 automated investment tomorrow?